Hello everyone. In this video, we'll talk about how an investor can classify or categorize the multitude of companies that we have out there in the stock market into six distinct categories. And particularly, this concept was made famous by Peter Lynch, and it has been very much, it has been well articulated in his book called One Up on Wall Street. So I would urge all the investors out there to read this particular book. So, Peter Lynch, what he had done in this particular book is that he used to categorize all the companies out there into six different categories, and these are the six categories that I'm going to, discuss about in this particular video. So, to begin with, the first category is slow growers, and this particular category used to include the companies which are large and aging companies, and their growth rates are in line with the economy. So, let's say if the economy is growing at a rate of say 5 to 6%. So more or less, the growth rate of these companies would be, so you can expect the growth rate of these companies in line with 5 to 6% if that is the rate that the economy is growing. And basically, one of the key characteristics of these companies is that these companies usually pay very high dividends, and it makes sense as well because these companies do not have much runway which is available for growth. And then I think it is prudent on management's part that if there are not enough opportunities available for the excess capital, so it makes sense to declare it as a dividend rather than putting it back to the business and then not earning the returns in greater than the cost of capital. So I think it is a good approach on management's part that to declare it as a dividend, whatever the excess free cash flow the company is generating. And the third point for slow growers is that these companies, they initially started out as fast growers, and then with the passage of time they became matured as more and more competitors came into picture, more and more players came into the industry and stabilized it. So I think these are the few of the key pointers that that he has mentioned in his book about the slow growers. And I think in Indian context, we can say that all the PSU stocks can be categorized as slow growers and whose growth rate is in line with the Indian economy. So that was about first category. The second category is stalwarts, and these are your typical blue chip companies. So companies like TCS, Infosys, HDFC Bank, HDFC Limited. So these are your Hindustan Unilever, Nestle. So these are your typical blue chip companies, and they have a typical and they have a very consistent and robust free cash flow. So because of the inherent robustness in their business, and these also one of the key tenets or one of the key characteristics of these companies is that they do not fall much during the recession or economic slowdown. So I think as we can see in the current environment that we are having in such a volatile environment, these companies, they usually fall less. I mean, the share prices of these companies do not fall as compared to other companies that we have. So that is one of the key characteristics, that they are sort of recessionary proof. So let's consider an example of an FMCG company. So companies like HUL or Nestle. So the products of these companies are being used by everyone in their day-to-day lives. I mean, it doesn't matter whether we have a recession or whether we have a slowdown in the economy. The products of these would be used in our daily life. So they don't fall much. And as a result also, so again, corollary to this is that as a result that they do not, that you will not find them at a cheaper price earnings multiple. You will always find them at a very much high P ratios and all. So that because they don't fall much, so they don't so you're not going to find them uh, uh, you're not going to find them very cheap in the business in the markets. And the third point is that they usually pay consistent dividends. So it is not that for one quarter they paid and for the next 3 quarters they don't. So it is not like that. So they due to their inherent robustness in their business model, these pay consistent dividends time and again. So that is how these businesses are classified under stalwarts. The third category that we have is category of fast growers, and these are your typical growth stocks. Stocks, the companies which have been reporting 25 to 30% growth year on year. So these are your typical growth stocks, and this is where we can have multi-baggers in our portfolio. So this is also called as the land of multi-baggers. And again, as I mentioned, one of the key characteristics of these particular stocks is that there is a plenty of runway for growth which is available. So let's say whenever we are seeing company like Bajaj Finance and or companies which are reporting consistently quarter on quarter good results and all. So these are the companies which can be categorized under fast growers. But then again, the corollary to this is that since everyone knows that these are the fast growers, so the investors usually bid their prices very high, and then during times of slowdown like currently that we are witnessing during economic slowdown and all, these also are the companies which fall very much as compared to this index or as compared to the market as a whole. So that is also the point we should also keep in mind. And again, third point is that don't usually pay much dividend because they feel like whatever the excess free cash flow the business is generating, it make more sense to put it back into the business, or maybe you can acquire other businesses through an inorganic route. So these are few of the key characteristics of a fast growers. Uh, Coming to the fourth category of this fourth category of companies, the fourth one is the cyclicals, and these are the typical commodity businesses that we have. So let's say, for example, we have automobiles, we have metals, we have companies operating in cement sector and all. So these are our typical cyclicals that I have been talking about. I have talked about in most of my previous videos as well. And the key characteristics of these companies is that the performances of these companies are they go hand in hand with how a nation's economy is working out. So let's say if during the times of boom, the metals, automobiles, they'll have some good periods, and then whenever there is a slowdown or a recession, the prices of these companies will get hammered like anything. So this is the key characteristics of cyclicals, and the timing is something which is very important in case of cyclicals, and hence and as I mentioned in most of our previous videos, that if you are working, let's say if you are working in a steel company, or if you are working in a if you are working in an automobile industry, so you will know much better than as compared to a person who is not working in that. So in that case you will have an edge over you'll know that what exactly or when exactly the metal prices are rising, and you can take you can take benefit of it, and take good profits from that. So timing is a most critical element whenever you are investing in a particular cyclical company. Timing as well as knowledge. If you're working in that industry, then definitely you should invest it. But then if you don't know how the metal prices behave, or how the commodity sector is behaving, you should not try investing in that, because it can be very dangerous. The fifth category of the fifth category is called asset plays, and basically these stocks are valuable in terms of assets like real estate. If a company has pile of cash in its balance sheet and all, or if they have investment, if they have done some investment in securities. So when I say securities, it is like your bonds and stocks of other companies. So it can be a hidden asset, or it can be anything. So basically these companies, as a business, they might be doing okay types, not good, not bad. I mean, they can be mediocre, but then important point here is that the underlying asset which may or may not be truly reflected in the balance sheet. So let's say, for example, if a company owns a lot of real estate, but then as per the accounting norms, the real estate is usually carried out at the cost of the real I mean the real estate value is carried out on the balance sheet at the historical price, or the purchase price. And over a period of time, the cost of that particular land, or the cost of that real estate, or the price of that real estate may increase over a period of time, but then the balance sheet may not truly reflect that. So again, we may have to dig and go beyond the balance sheets and all. So if a company has a lot of these sort of hidden assets and all, which may or may not be reflected in a balance sheet, then these are typical candidates, and these are the sort of opportunities that the value investors are always looking for. An example would be like, say for example, DMart usually owns a lot of these stores and all. So it has a lot of real estate on its balance sheet, which may or may not be reflected fully into that. So I think that could be one of the asset plays in Indian context. And the last category of this would be turnaround. So basically turnarounds are the companies which have been, brutally hammered by stock markets, and these are the sort of companies which are financially distressed, or companies which have gone bankrupt. So as a result of this, their share prices have taken a massive plunge because of all the negative news which is being circulated in the media and others communication channels. And again, so basically what these value investors do is they look at it, and again they plate these sort of opportunities from a margin of safety perspective. So in this, it is very important that if you are not aware about the business model and the, what is happening, so usually investors and particularly retail investors should refrain from investing in turnarounds, because as Warren Buffett has also mentioned, that turnaround seldom happens. So it is to our own benefit that if we are not, well aware about the happenings and all the news and information that is going around, then it is to our advantage to refrain from investing in turnarounds. But then if you are someone who is, who knows these things, and all these things, one only gets to know with experience and all. So if one is an experienced investor and specializes in these sort of categories, then these can be a vehicle, or these turnaround situations can give stupendous returns if one has the if one can quickly or if one can grab this sort of opportunity, and one has an eye for this sort of opportunity, so there is a very good profit that can be made if investing in turnaround. But then, as I said, again, it is a double-edged sword. So if you are not aware about the underlying business at all, it doesn't make any sense to invest in turnarounds, and maybe we can stick to stalwarts and again fast growers and all. So guys, that was about the different categories of businesses that was made famous by Peter Lynch. So if you have any doubt, any concept that you have not understood in this video, or you want to know more about investing and all, so you can comment in the comment section, and I'll be very happy to help you out. So that's all for today, folks. Thank you and have a nice day.